Yeah, the market has really grown tremendously just in terms of deal flow and acceptance and understanding of the market. When we started doing secondaries uh, back in 2017, 2018, it was probably a $3 to $5 billion a year deal flow market. Today we're going to see close to $40 billion of deal flow just in 5 short years. So there's a lot of opportunity to look at, both in the LP side and the GP side of what we do. So it's really grown tremendously just because the market of private credit has gotten so large, and the acceptance and desire to want to rebalance portfolios and seek liquidity has become much more common. Yeah, I think from sellers, there's a huge need to rebalance and just manage their liquidity, manage their portfolio objectives and risk management goals. So I think there's just much more acceptance from LPs around using liquidity solutions for their credit portfolios. And then on the GP side, because of the state of the fundraising market or desires to grow or manage portfolios, they're also seeing increasing appetite for these types of liquidity solutions. So from the user standpoint, there's a lot more interest and acceptance and understanding. And then from our perspective as investors in this area, we're seeing a lot of appetite from LPs as well, looking for something different in the private credit landscape from a return and risk perspective. I think they're going to continue. We're still in the very early stages of the development of our market. It's gotten big quickly, but compared to other secondary markets, we're still very, very small and very much in the early innings of growth. Holders of assets have different levels of liquidity need at different points in times. I think there's a natural, steady cadence of opportunity to get liquidity for those holders of assets that are seeking to rebalance or adjust their portfolios. But then there are times of market volatility. There are times of, dislocation in the market that make those liquidity needs higher, just like in any other asset class in private credit. And that's where I think the strategy can be even better, more interesting. For holders of assets, typically when they see market volatility or dislocation, they tend to step back and reassess their own balance sheets and their own liquidity profile and the like. But I think they can always remain confident in that there are other markets in secondaries, whether it's private credit, private equity, or infrastructure, where if they want to rebalance, they can assess and get that type of liquidity need. So the private credit asset class is 1.7, 1.8 trillion. Various estimates think it's growing at 11% to teens plus percent a year. So the more formation in private credit, the more managers, the more vehicles, the more investors, just means that there are really attractive tailwinds around the need for liquidity in the future. Private credit secondaries have been done since the late 1990s. We've been doing them since the late 1990s, but really on a dedicated basis, over the last 6 or 7 years. So I think the market is still understanding kind of the full potential of that type of market opportunity, but the macro is very strong in terms of just the asset class growth. So the bigger the asset class, the more the need for liquidity over time.